All right, today we're going to talk about something near and dear to my heart, which is how to start a venture capital fund from nothing. Now, I've been working in venture capital for the last 14 years. At this point, I've raised over $90 million across multiple funds. And I'm going to show you if I had to start over from scratch, I had nothing, and I had to start from kind of a blank slate based on what I know today. This is how I would approach it. If I were going to start from scratch, I would have basically one big decision I needed to make. One is, do I get experience and build a track record on someone else's dime, or do I hustle and get it on my own dime? Now, let's talk about those two different routes. So on the one route, if I'm going to learn on someone else's dime, which is what I've done in my career to date, I would go and try to work at a venture fund and rise through the ranks, find deals, invest in companies, build that track record. Now, track record is incredibly important to being able to raise a fund, because if you think about what you're pitching to investors, you're essentially going to them and saying, hey, trust me with your money for 10 years, and I promise that I will invest it in some really great investments that'll generate a really great return for you. I have no clue what they are, but it's going to be great, I promise. How many people do you think are likely to be able to raise money off of that pitch, even if they have a great track record? Let me tell you, it's really challenging. But if you don't have a track record, it's essentially impossible. And so that's what you need. First thing you need is that track record. So the question is, how do you get it? You either get it by working in another firm and building a track record there, or you go and do it on a deal by deal basis. Now, here's the pros and cons of each. If you're going to go work for another firm and build your track record with them, you may not be able to take that track record with you. And it's kind of convoluted, right? Because investors may look at that and say, well, was that really your deal? Or was it the other people at the firm's deal? And the firm may not be willing to back you up that it was actually your deal, right? Track record is this super sacred, sharp elbows thing in private equity and venture capital, because it's so fundamental to being able to raise more money. On the flip side, if you say, okay, that's going to be a challenge, maybe I'll just do my own deals. The challenge there is that it can take a while. You got to raise money deal by deal by deal. That said, let's talk about raising a fund if you are coming from nothing, but you love startups and you decide you want to go down this route. Rather than learning on someone else's dime and building a track record there, you're going to do it yourself. So the first thing I would do is I would set up what's called an SPV, a special purpose vehicle. And I would go out and I would find a really great deal. And I would do all of the due diligence on that deal. I'd evaluate the market and the competition and the management team and the business model and the financials, and put together a really nice investment memo that covers all of those different areas. And then I would go to investors and I'd say, here is this amazing deal, right? I'd have them sign an NDA and a non-compete, and I'd say, okay, here's my investment memo, right? My deep dive into all the due diligence of this deal, and see if I could convince them to invest through me in that deal. Now, the other thing you'd have to do is you'd have to go to that entrepreneur and convince them to give you an allocation of their round. And this can be challenging, but if you're willing to hustle, it's totally doable. So you get the entrepreneur on board, you get your investors on board, and you take all of their investment through this SPV, this special purpose vehicle. Now, the cool thing, an SPV is simply this legal entity that is designed to do one thing. That's why it's a special purpose, right? And that is, in this case, to invest in the company. So your PPM is going to have two important documents. It's going to have your operating agreement, and this operating agreement basically outlines how the SPV will function. So it basically says this SPV, this entity, will invest in this one asset, and here's the fee schedule in terms of how much the manager of the SPV, you, are going to get paid if the company is successful and otherwise. And then you'll also have a subscription agreement. And the subscription agreement is the document that your investors in the SPV are going to sign, basically, and make their commitment to the SPV. Then you'll gather up all the funds and all the subscription agreements that are signed. You'll close the fund, and then you'll invest in the company. You'll probably need to do this a few times. But here's the reasons you want to do it. So first of all, you can actually charge fees for this SPV. Now you're going to need to charge some fees because it's going to probably cost you somewhere between $10,000 and $20,000 to set up one of these SPVs in terms of legal fees. So, but you can have your investors cover that expense. So you'll have kind of just basic setup fees. You can also charge a management fee. And the management fee can be either paid annually or you can charge an upfront fee. So I've seen everything from like 1% up 1 to 5% upfront. I've also seen 1% per year paid upfront. And so like, let's say you do like $100,000 deal. Well, you could get paid like $5,000 for putting that deal together up front. You can also charge carry. So if the deal is successful, then you could charge, I've seen typical carry is 10 to 20% on SPVs. So your $100,000 becomes a wild success and returns $1 million, right? That gives you $900,000 in profit. And of that $900,000, let's say you get 10% carry, that's $90,000. So your total payout is $95,000 on just one deal. So that's how the SPV works. Now, how do you get from an SPV to a fund? Ultimately, you're trying to build a track record. And as you do SPVs and you're selling these deals, you're building confidence within your network, and you're also able to show good returns, hopefully, if you're doing your job right and investing in great companies. So after you've done a couple of these deals, 1, 2, 3, 4 deals, you'll start building a track record where you can point to, hey, here are the deals that I've done, here's how they are currently performing, and here's the kind of return that I'm generating for my investors. You then take that information and you go and pitch more investors, right? You don't pitch them on a deal by deal basis, you pitch them on investing in the overall fund. Now, just to really quickly touch on that fund structure that you'll ultimately be pitching, you'll have what's called your limited partnership. Your limited partnership is the actual fund. This is where the funds reside. And when you invest in companies, you're giving them money and they are giving you back stock certificates. Those stock certificates are held by the limited partnership. The limited partnership is really a partnership. It's a collection of all of your investors who put in money into your fund. Now, the limited partnership is called a limited partnership because it is limited in terms of the amount of control it has. And it gives that control to what's called the general partner. Now, that's you in this case. You're going to set this up, and the general partner gets to decide where the money that sits in the fund gets allocated in terms of investments. The other entity that you have is what's called the management company. Now, the management company is kind of the entity that you work for. It's the advisor to the limited partnership, and it maintains a contract with the general partner to provide those advisory services. The way that these different entities get compensated is the limited partnership will pay a management fee to the management company. This management fee usually represents about 2% of assets being held within the limited partnership, and it's used to cover the day-to-day operations of the fund. So this could be like paying for rent, travel, salary, etc. The general partner gets compensated based on the performance of the fund, and that's carry. And that carry is just like the carry that we talked about with the SPV, so it's roughly 20%. It could go as high as 30%. I've seen that in some cases, but industry standard is about 20% of the profits. Now, here's the cool thing about these funds. So what you'll do is you'll raise a bunch of money into this fund, and then you'll go and invest it in a whole bunch of companies, right? And hopefully those companies do really well. But once you've invested all the money into all these different companies, then you're out of money, you go back and you raise another fund. And if you've been doing a good job for your limited partners, one, they'll invest in your next fund, but they're also hopefully going to refer you to other investors and have them invest in your fund. And so over time, you can get these funds and they get bigger and bigger and bigger and bigger. And as you raise more funds, that's how you end up generating really, really big returns, not just for yourself, but also for your investors. If this video was helpful, check out my other video where we talk about how to get into venture capital without any experience. And in that video, we're really gonna help you take that first step into building a track record on somebody else's platform.